If you're a swing trader who was long during the month of November, you've been richly rewarded with a big rally, including an 11% run-up of the S&P 500 since the start of the month. That's a huge rally for an index, and traders who were long all month have profited handsomely for hanging in there and staying long. But those same traders grow increasingly anxious that a pullback will wipe out their strong gains and often turn to the options market to hedge those gains with put options. I'm Seth Freudberg, the head trader of SMB Capital's options trading desk here in Manhattan. And professional options traders like the guys on our trading desk are trained to understand how to structure options trades to take advantage of the hedging properties of options. The problem is that put options can be really expensive, and the cost of those put options can sometimes put a major dent in a swing trader's profits if he doesn't know how to structure trades like a professional options trader who can employ techniques to keep the hedge costs way down with a technique we'll teach you in this video. In fact, sometimes the hedge can actually be structured so that it ends up being free. So if the idea of a free downside hedge to lock down profits from a big rally would be of interest to you, then stick around because I think you're going to find this eye-opening. Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so in the month of November, the market seems to have gotten very excited about the idea of a variety of drug companies bringing very effective vaccines to the market. Finally, hopefully putting an end to this mind-blowing epidemic that we've all been living through and the economic reopening that should follow the distribution of those vaccines. And so even before the presidential election took place, the market started to rally and really hasn't looked back since, with the S&P 500 up over 11% in less than 4 weeks this month. And that is a very strong rally. Now, swing traders who caught this full rally are sitting on some pretty serious gains. And while there could be more gains ahead, most traders would rather do something to lock those gains in. Well, selling some of your shares and taking profits is certainly one of those ways, but you'll have tax consequences to that, which you may not want to face. So what some traders like to do in these cases is to pick a natural support point for the market towards which the market may drive in the event of some kind of a sell-off, and then buy a long-dated put option at that support point. So let's take a look at a historical example of how this could have been done. And if we look back in time to August of 2018, we'll see that there was a similar rally which took place that year, such that from early April through late August, the market also rose about 11%, so that by August of 24th of that year, the SPX index had run up to 2874. Now, some traders at this point might expect a pullback after such a large run up. And so, as we mentioned before, what some traders like to do is to hedge their portfolios in a situation like this without the hedge costing an arm and a leg. And options, particularly index options, can furnish you with a really interesting way to implement such a hedge where you can cut down on the cost of that hedge substantially through this strategy that we're about to teach you. Now, before we get into how the strategy works and how you can actually arrange to have a free hedge, I wanted to let you know that beyond what we're teaching you in this video is that there are a large number of sound, viable long-term techniques for trading options for income. And in that regard, we're currently running a 2-hour free intensive workshop where we'll be teaching you 3 of those strategies that real professional options traders use. And in that webinar, we'll be teaching you a really simple but incredibly effective strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like, where you'll make your target profit, whether the stock goes up, goes nowhere, or even goes down a small percentage. So if you'd like to learn these strategies, then just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can register for the workshop at optionsclass.com. It's not often that retail traders can be taught strategies employed by actual Wall Street traders, but that's exactly what you're going to be getting through this free online workshop. So click the link to sign up now and don't miss it. The strategy I'd like to teach you involves the use of index options, as I mentioned, and most of you are probably familiar with index options, but there may be some of you who just have a passing knowledge of how they work. So I'm going to do a really quick review of the basics so that you'll understand this strategy. For those experienced options guys out there, don't worry, this will be quick, and then we'll jump right back into the lesson. So you're probably all familiar with how equity options work. With equity options, a call buys you the right to buy 100 shares of stock at the strike price of that option at any time before the option expires. And a put option entitles you to sell 100 shares of a stock at the strike price of the put before that option expires. But there are also index options, which work similarly to equity options, except that there's no such thing as 100 shares of an index like the S&P 500. So you can't really buy or sell 100 shares of an index. But what you can do is get paid in cash $100 per point if the index expires above the strike price of an index call that you buy, or alternatively, you'd be paid $100 per point for each point the index drops below the strike price of your index put. So for example, if the SPX index is trading at 3,000 and you buy the 3010 call, if the SPX goes to 3015, you'd get $500 into your account. If the index closed at 3010 or lower, your call expires worthless. On the other side of the ledger, if you buy a 29.85 put and the market sells off to 29.75, you'd make $1,000. But if the market just sold off to 29.85 or higher, the put would expire worthless. So those are the basics of index options. Okay, so if you look at the price chart of SPX index in 2018, you'll see that while it was tested numerous times throughout the year, that 2600 level acted as pretty reliable support during the year. And so by late August, the index had rallied right up to its all-time highs, which, as you can see, is the 2875 area, which is a similar situation to today, where the market is again hovering in the area of its all-time highs. And so suppose that you felt there was a pretty good chance of a pullback and that you were sitting on all the gains from this November run-up that we've just experienced. So let's take a look at what would have happened had we purchased 5 December 2600 puts for $23.78, expiring on December 21st, 4 months from now, under the theory that if the market were to pull back, it would head right back down towards that 2600 level, which would make those puts very valuable. Now, from a cash flow standpoint, each option costs $23.78. But remember, each index put option pays off at a rate of $100 per point below the strike price of the option. And so you multiply that price by $100, and we bought 5 of them. So the total cost ends up being $11,890. Now, depending on how large our gain is, of course, that may or may not be a large cost to protect against a pullback, but it's still a lot of money. And if the market doesn't pull back, that money goes down the drain. And so options traders in a situation like this utilize a technique for reducing, or in some cases, eliminating that cost completely through a technique known as a calendar spread. So let's take a look at how this works. So if the trader sells 5 of the 2600 puts which expire in September, then this combination of short puts expiring in 1 month and long puts expiring in a later month, that combination is known as a calendar spread. And the point of it is that if you sell those puts, you're going to receive cash that helps to offset the cost of the puts that you bought in December for protection. So now let's move forward to September 14th. And as you can see, the market did not sell off and in fact rallied further to 2,905. And so 7 days before those September short options were to expire, they had dropped down to 23 cents, which is 10% of their original value. So at that point, most traders, having squeezed most of the gain out of those September puts, which remember we were short, so those puts losing value is a good thing for us. We just closed those by buying them back for 23 cents and then selling the 2600 puts that expire about a month later in October for $3.10. So let's take a look at where we are from a cash flow standpoint so far, so you can understand really what's happening here. So remember, the original cost of the hedge was $11,890, but we sold now both the September and October puts for $11.50 and $15.50 respectively. And then there was a small cost to close those September short puts, remember. And so as you can see, we're chipping away at the cost of that hedge, those 5 puts in December, down a few $1,000s to 93.05. So if it turns out not to be necessary to have owned those puts, at least we don't have to have spent very much money for that protection. Now let's move forward to October 11th, a day before the October's expired. And as you can see, the SPX dropped quite a bit from a month earlier. So when we buy back those October puts in our campaign to reduce the cost of the hedge, you'll see we actually have to spend quite a bit of money to buy those back, $12.87 for each option, because those puts have become more valuable as the market drops and approaches the strike price of those puts. But look at how expensive the November 2600 puts have become. We can sell those for $31.60. And so now look at where we are on this trade from a cash flow standpoint, because it's pretty interesting. And as you can see, selling these now pumped up November puts for over $31 brings in so much cash that even though we had to pay a large amount to close the Octobers, we now have positive cash flow on the trade of $60. So now we not only have paid for that hedge, but we have an extra $60, which can happen sometimes with these calendar campaigns. Now, let's move forward to the day those November options that we just sold expired. And as you can see, the index had rallied up to 2781. And so the November short options we sold expired worthless. Now, it's important to understand at this point that we have now collected $60. But remember, we still own those 5 2600 puts, which we now own for free, if you think about it. Now, we could go ahead and sell those right now and make a nice profit on the whole calendar campaign. But just for the fun of it, let's say if we still had a conviction that a large sell-off was coming in the future, we could just hold on to those 5 puts, knowing that we've at least guaranteed a $60 gain no matter what happens, because we'll always have that $60 of cash flow from selling so many short puts against the long December puts during this campaign that options traders again call a calendar spread campaign. So now let's move forward to the day before those puts expire. And as you can see, the market did in fact sell off, and those puts have now skyrocketed to $127.21 in value. So if we were to finally sell them before they expired at that price, let's look at the outcome, which takes the income we received from selling and rolling those short puts from month to month and subtracts out the original cost of those 5 puts, and then adds the amount we were able to sell those puts for, with a spectacular final outcome of over $63,000. Now, what I'd like you to take away from this video is not so much the incredible gain that could have taken place in the final month of the trade, so much as the fact that a trader who's looking to protect his gains from a big run-up in the market is not faced with the binary choice to either pay a huge amount for put options or risk losing the whole gain, as would have certainly happened in this case with the market selling off so drastically. Rather, there's a third alternative where you can enter into a campaign that reduces the cost of the hedge down to a very small amount, or in this case, actually eliminate the cost completely, yet you still have the full power of your protection if you need it, as you did in this case. There are lots of tools like this available to professional options traders or anyone who learns the principles of options income trading, like the guys on our options trading desk. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should just check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so you won't lose this video, don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on that subscribe button right now so you won't miss all of the free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.